Volatile day in the stock market, bond markets being a little wonky. We're going to dive deep into this development and divergence going on between the bond market and the stock market and what it has meant in the past. The inability of FRC, First Republic, to find anybody either to partner with, and the rumor that's currently circulating on the bank, while this one chart is flashing a glaring red signal. The recent signals giving in the smart money, dumb money confidence index, two stocks that are just defying gravity. We have VKTX that we're going to cover, why it's up 70% today. Baba breaking out on news of splintering into several different companies. We're going to cover this in detail. Let's get to it. Now, after a very quiet day, the S&P stayed right in line. Now, that's important that we just note the basics, right? We know that we are still above the 200-day moving average, and we're not going anywhere. We still have this DTL, and we can see that really obviously right here, but let's just put it in so that we get it, right? That is pretty much the standard line. A couple times we tried to get over, and now we have these points. This is not ideal. This is not really what you want. You don't want to see the lower highs, and that's exactly what we're seeing. What we want to see is we want to see strength, and we're not seeing that. We're seeing this sideways action where we're not going anywhere, and it's like we're waiting for something to happen that just hasn't happened yet. Now, we touched on this yesterday, and I want to explain what is going on. This is MOVE. This is the Bond Volatility Estimate Index. And the best way to explain this is to think of a VIX or buying bond protection. I know it's very boring, but if you're buying bond protection, then you think your bonds are at risk, right? Considering everything that's been going on lately, you could see why somebody might want some protection on their bonds. This moves in tandem with the VIX. The blue is the bond market option volatility, or MOVE, and VIX is below. The issue that we're running into is that we have this divergence going on where we have a spike and then we're trying to come down, but we're not seeing the same exact pattern. And this is bothering people because it's definitely some kind of divergence that we're seeing where we took out this low and then we actually are going lower here where you're rallying here. So in other words, people are buying protection in the bond market, but they're not worried in the stock market. That's a divergence, and that's worth mentioning, and it usually does not end well. Usually the MOVE or bond protection moves first. And you can see that real clear here, and I'm just going to use the pandemic as an example, how we're peaking right here before we actually peak on the VIX. Remember that the MOVE is in blue and the VIX is in orange. So usually we get the MOVE first in the bond market. You can see that here in 2009 as well. You're getting that MOVE in the bond market before you're seeing these peaks in the stock market. So MOVE is peaking before the VIX. Now, if we take a snapshot of this over a shorter period in time, you can see really clearly here that this divergence has been getting wider and wider as the years going on. And that's okay. That can happen as long as we're seeing some semblance of consistency and correlation. But when you have divergences like this, you need to pay attention. Optimally, what we want to see is we want to see the MOVE drop and catch up to the VIX. But usually what happens is the VIX follows the lead of MOVE. I'll explain why this is important. In front of us is the Nasdaq relative to the S&P 500. And we can all see that very clearly, right? Right up here, QQQ, relative to the SPY. Here's our level where our neckline is. Here is when you're in a bull market and you run. As you base and go sideways, try to figure out your way. You might get some relative outperformance or underperformance each way. As the market starts to drop, and you'll remember, note this is the peak, the S&P will always outperform the Nasdaq. So in bear markets, the S&P always outperforms the Nasdaq, relatively speaking, and then the exact opposite in bull markets. So once you started breaking down, well, that was not what we wanted to see, but the rally was definitely something we wanted to see. And you can see our level right in here. And then we had the greatest run that we've had in 18 months since January, and as outperformance in this sector. Now, why is this important? You want the Nasdaq to lead. The Nasdaq needs to lead in order for it to be a bull market, as it was explained back here. Can you have periods where certain sectors are going up? Yes. But if you want to get the breadth of the market, you really need the Nasdaq, and we can get into the semiconductor index, which we will shortly. But this is what you need. Now, we're running right into a key level that we rejected back in August. And then from that August date in the Nasdaq down, things did not go great for us. Now, I'm not saying that we're going to come down, we're going to take out new lows. Nobody knows. The issue is that the bond market is pricing something in. And we can see that with where a move is, right? The US bond market option volatility estimate index. Well, let's just go through how bad this is if you just want to keep this in mind. Okay, this is the pandemic. This is where we're at right now. So if you kind of drill through this, you just take a look and go, well, when was there a time when it was worse than this? Well, that would be the great financial crisis, but it was not during the pandemic. To illustrate this point even more, the VIX is in orange. Look at the VIX over where you are right now. So this signifies and should show you what a major disconnect this move is. Now you can get these quick moves like you did here and then come back down, right? Quick move comes back down. It follows but doesn't follow the same way. People get a little more skittish. Sometimes the VIX is obviously going to be a little more skittish than the bond market just because of retail is not really that heavily in the bond market. But what you're seeing here is you're not even in the same realm. You're not even in the same percentile on where you're at or historically have been at in regards to a correlation. That's the issue. Now, if we zoom in and we take a look at the Nasdaq versus the S&P and we see the test right here, the rally over, the drop. So as the market's getting worse, we're seeing what? The Nasdaq underperform. And this is that key level that we were just talking about that went on for 3 years, which you can note very clearly how we're responding to that area. This is what we refer to as a red flag, and it's something that we have to have and pay attention to. Now, the robustness of the market cannot be understated here. So even these moves that we're seeing where you're having these DTL moves and I'm waiting for them to break, I'm not really seeing that, right? I'm not really seeing the breakdown. Let me give you an example. So if we take a look today and I get rid of all my little fancy levels, well, I have a dragonfly kind of flips, gives me a gravestone, breaks the gravestone, doesn't go down, gives me almost another dragonfly pattern right there, and looks like it's going to lift. So let's clean all this off. And let me just show you this because I find this part of it fascinating. You're really in the same range. So if you look back at the past 5 days, NVIDIA is sitting in there. So the resilience of these names cannot be understated. The question is, how long is that going to go on for? Now, one of the core things that I think is really holding us back is I don't think anybody truly believes, right from that break, you can say, I don't think anyone truly believes that the banking crisis is over. Now, we have a statement today that's coming out on FRC, and that statement is the bank is no longer for sale. Well, it was for sale for 3 weeks and nobody wanted to buy it. So maybe they're saying that as some kind of vote of confidence. They're circulating it around. Well, they're no longer for sale, like they fixed their problems. There has been no announcement, anything like that whatsoever, that would even hint that their problems are completely fixed. There's been no statement by the company. We just have a stock that's down 90%, and we just have Yellen and everybody saying, by the way, everything's fine. And I just want to point out the obvious. Everything's not fine. In this New York Post article, you can see that Janet Yellen is actually reaching out to Henry Paulson asking for advice. So in one breath, she's saying we don't have a crisis, and the next breath, she's making a phone call. That kind of thing, that doesn't go unnoticed, and that's something that we need to pay attention to. Now, for some time, I've been getting asked to follow up on things. Smart money, dumb money, confidence index, and as you know, we refer to this as institutions and retail. We do not want to focus on it as just smart money, dumb money, because as institutions sold in October and retail bought, retail outperformed. Now we have something very interesting going on right now. We're seeing the divergence I just went over in the bond market. We're seeing that divergence, right? And that's always a sign that we have to be aware. But at the same time, institutions are not selling and retail is out there actually buying. So if we zoom in on this and let's take a 6-month look at this and see what we're seeing. So maybe we're getting toppy on the institutional side, but we're certainly not taking out that low from the 23rd. And then you start seeing how we're creeping up here on retail. So retail, once again, that was right back here, they're buying again. Institutions, last time they decided to dump or they were maxed out, that was the low. Now, I'm not suggesting that that's what's going to happen again, but if institutions stay up here and if retail continues to buy and you get something similar to what you had back here in June and July, well, you could see a pretty substantive move in the market for a couple months. So while we're seeing everything unwind in the bond market, meaning buying the put protection, the CDSs, we're not seeing the panic, the sheer panic that I would expect to see in the market yet. And that's a bifurcation, and it's definitely something to focus on. Now, in front of us are BBB bonds minus AAA bonds. Now, what do I mean by that? It's giving you a spread. What is the spread between investment grade to the top bonds, right? They just overcomplicate it. But this is where you were with the spread. And remember where the move was? Remember where let's just go through it. So this is where you were during the pandemic. This is where you are now. This is where the spread was between BBB and AAA bonds during the pandemic. This is where it is now. So while we're seeing buying of that protection, we're not seeing the spreads change at all. A matter of fact, if we really got into the spreads and looked at them year to date, you have not gotten above that mid-March level. So there is a huge disconnect here between what's going on with the bond volatility index, the VIX, and it does not look like the bond market from a bond spread yield perspective is phased at all. So this is what we know. We know that we have an outsized move. Wasn't trying to make that rhyme, but it looks like I did. And we have the VIX that's not following along the way that it's supposed to. I mean, this is a clear non-correlation when you look at it. There's really no other way to say it. During the entire drop, here's the S&P, here's that DTL on the S&P, and there's those two red dots that are just showing you the lower highs. At the same time, the market's going sideways, the VIX is dropping. So that doesn't really make a lot of sense either. Usually when the VIX drops, equity prices go up. VIX drops, equity prices go up, right? It's a pretty standard move. If the VIX drops, equity prices go up. The VIX is dropping and we're not really going anywhere. There are a lot of disconnects out there right now, and that is why you're seeing the panic now. If, and this is a big if FRC got it together somehow, and they're going to make some kind of announcement, that might be something that could put some kind of interim bottom in the deposit run and in the banking space. That could make the market start at least basing a little bit and give us some semblance of what's going on. The biggest disconnect for me is that it's been 3 weeks and we have nothing done. There's nothing here except the Fed keeps stating that they're going to have more and more credit. And that's a problem, because all they're doing is the inevitable. As you extend credit and people withdraw their deposits, you're just prolonging the inevitable until you come up with a solution, whatever that solution may be. So if we look at the long end of the bond market and we take a look at the 20-year, you can see that we're hardly moving. You've been bouncing around. You had a lot of buying coming in mid-March, and then you had problems with the bank, and all of a sudden you had weakness in the Treasury market. That doesn't really make a lot of sense. If you look at roughly the same exact period in time, you're looking at the 2-year Treasury right here, and look at how we've gone from 5%. At one point, we were at 3.57, and now we're back to 4%. This is not what you want to see. So in other words, we're getting tighter and we're seeing more buying on the front end, but on the back end, we're not seeing it. And I want to explain this. This moves like a dragon. So in other words, what you should be seeing is, think of a long tail, right? When that tail whips, this end, the long end, is supposed to move first. As a matter of fact, if you talk to any bond desk right now, they're going to be telling their clientele to go out and buy the long end, not the short end. Because if rates are going to come down, then that's where you're going to get your leverage, on the long end. But it's not moving. This is another disassociation. And quite frankly, the only thing that I could think of is that there is a massive, massive short position on the front end of the bond market. And that is what we're witnessing. And there is a huge short position there, but they must be covering. But eventually, this should grind and move higher. Before we get into some key levels, make sure that you do get the newsletter. It's free, link in description. I walk through these in detail in the newsletter and why they're important. But just to explain it, you'll see XLY, XLP. This is discretionary, consumer discretionary by Consumer Staples. Think, do you want that new pair of jeans, or do you need to go buy Clorox and Procter & Gamble? So when these are working, this is a third of our economy. When this is working, it's usually a bull market. When XLY is not outperforming and XLP is, it is usually a bear market. What you're seeing here is a very similar situation to what you're seeing in the Nasdaq SPY, but it gives us a more indicative look on how funds are positioning themselves because they're buying staples and they're selling retail. And you can see how we got right to that net level and we're seeing that rejection. So do not rule this out. This is significant. And it's clearly saying that people are being defensive. And we can see that, but we're not seeing that action followed through the asset classes the way that it's normally supposed to be done. Now, if you look at Tesla, which is a great bellwether, you can just see we're following the same exact pattern that we've been following. Very little to say there. There's very little going on there except the fact that it's not above the 200-day moving average, and the past 5 days have been red. So I don't see the hurry to get in there. You're once again making a new closing low. If we just drop something as simplistic in, you can see right here, and I'll just show you, it's the 9 EMA. So you're just sitting right in there. Now, if I take this 9 EMA and we'll just use the short symbol and go and take a look at a 5 SMA, which is the shorter version, which people look at, you can see you're pointing down and you've closed below it for the first time in about 2 weeks. You really wouldn't say that this is a close below it since you kind of closed on it. Same here, but that's a pretty definitive close below the 5-day moving average. Now, whether or not that means that you're going to do something like this or something like this remains to be seen. It's simply one data point, but it's a data point worth noting. VKTX absolutely skyrocketed today on news. This drug performed significantly better than the most bullish analyst on the street. So that's about as positive as you can get for a study, is that it outperforms even the most bullish analyst. Now, this was a really simple trade we did in the community today. All we did was a 1-minute orb. We let the bar form. And once that bar formed right there, we were just looking for the higher high. It's a really simple trade, 1-minute orb. I may actually do a video on this. Comment if you'd like to see that below. It wouldn't be a very long video. But what you're doing, and it does work, and there's more to it than this. See how all of a sudden you're over, see where your low is. So I'm just quantifying my risk and realizing that I'm going to lose about 50 cents with slippage. That's all I needed to know. And then you just start utilizing the stock. Now, whether or not you're going to scale out into it, and we trimmed in here, I actually trimmed in here as well. And you come back down because you just don't know what you're facing today. And it got really simple way to just start going through this and just looking at the levels. And really, it's very simply all you're doing is just moving your stop up the whole time. Now, I like this and I like the move. And you should see companies like this benefit greatly from what they're doing. But my concern was the fact that they have literally zero in cash, right? They have cash, and I was talking to someone about this and they were discussing the burn rate. They don't have enough money right now to fund this entire operation. The question is, are they going to do a secondary? And the answer is nobody knows, right? No one knows if they're going to do a secondary or they're not going to do a secondary. Are they going to roll the dice into the next phase, or are they going to be prudent and do a secondary now? That's your risk, that you just have secondary news. I would prefer they do the secondary, the stock gets hit, and we go from there, right? Whether or not you think they have enough cash or they don't, companies always want to raise more cash when things are going well. This is about as good as you can get. Now, that said, we don't see any cracks here whatsoever. So you see a higher high on this tomorrow, and you're probably going to see more buyers step in. BABA is going to split into 6 different companies. When this happens, these moves are substantial. It's exactly the kind of thing that Buffett would love for them to do, and I believe they still have a stake in it. I'm not entirely sure on that, but when you see this, think of when you split up Standard Oil. Think of when you split up the Bells, right? For those that are older, you'll remember those. A lot of those guys that are newer might not remember Standard Oil, and that was Exxon, Chevron, and all those super majors were once one company. This is a massive value creation event. And I would expect people that understand that over the next 12 to 18 months are going to want to buy this. And so I would expect this to act very strongly. I have not been a huge proponent of this name at all, but I took a position in this pre-market, and I'm very happy with that position. I'm just sitting with it, guys. I mean, I can't be any clearer that I think this is something you should really look into. And I would go look at past splits Go look at the easiest one to find that made the most sense was when Icon pressured eBay to spin off PayPal. And look at the amount of value creation that came out of that. So it's definitely something to pay attention to. If you found this helpful, please comment. Your comments are why I create content. I tried to explain why you had two huge moves, and I tried to explain tonight why the heck the market is being so erratic, and I almost want to say dysfunctional, between the difference that we're seeing with what's going on with Move, what we're seeing going on out there with the bond market not participating on the long end. There's just a lot of, there's no other way to say it, divergences and bifurcation, and it's happening at key levels. So I hope this was helpful. Please comment, let me know. Have a great night, everybody.